Hi guys, welcome to Goal Today. This video is brought to you by the coach. Remember always our job is to make you rich. If you are a new subscriber, welcome aboard and thank you for joining us. If not yet, please hit the subscribe button. We are going to start our video with the economic calendar. On the economic calendar for Tuesday and from the United States, we will be waiting for the following economic headers to be released. We will be waiting for the Red Book month to month and Red Book year to year and CB Consumer Confidence for month of August and Richmond Manufacturing Index for month of August and Richmond Services Index for month of August and other important economic headers. That's all for the economic calendar. We'll be moving now to have a look at the numbers. On the last trading session of Monday, we have had a trading range from 1424 to 1555, numbers are rounded and the market is still open. Gold spot is expected to print a closing price above 1526. The numbers rounded and the market is still open. Gold is trading in a bullish trend above its all daily simple moving averages, and what matters for us is the 20 days daily simple moving average, as the first point of contact is about 1504, and this market is bullish above 1456, the 50 days EMA. We are overbought in the weekly and monthly charts with high readings, and the supports are seen at 1522, followed by 1511 to 13, and then the major support psychological level 1500, and the resistance levels are 1534.8, 1550, and then 1576 and 1600. That's all. We'll move on now to the trading strategy. The soldiers at the front lines, especially in the classical warfare, are at times more important than the chief commander of the army himself, since their lives at serious risk. You don't expect them to announce a false alarm, for they might get punished by their generals or killed by the enemy. Similar are the traders. They see it first. You got a combination of greed and fear, and a trader won't leave risky profitable trade and chase away bonds with petty yields unless risky assets are really ahead of a wave of systematic risk that is way from being hedged. That's why no one is supposed to ignore the importance of the inversion in the yield curve or make you feel that is something normal and is gonna fix itself by itself. We got some headlines today that helped the US equity markets and the US dollar to stop the bleed, as the President of the United States, Mr. Donald Trump, said that both China and the United States are ready to get back to the table and to negotiate a trade deal. Also, it was followed by another headline from Manchin, the head of the Treasury, to sign a deal in a second if China is ready to provide a fair deal. I did not buy this, and I'm not buying this because a few hours later, the editor of the Global Times, which is the voice of the Communist ruling party in China, and honestly, guys, I don't know how to spell his name, he said that China won't cave to US pressure. By the way, he is the same guy who leaked the last tariffs or last round of tariffs, which was imposed by China onto the American imported goods last Friday. So now we got a situation which we don't know who to believe, the United States or China. Are they going really to talk, or they are not going to talk? I don't know what we are going to do with this. In my opinion, I have another opinion on this matter. This is not a trade war anymore, it's an open war, and you can expect anything to take place. China, in my opinion, is buying time until the presidential elections takes place, on the hope that Trump won't be elected again and a brand new president will be there, with whom they will be renegotiating a trade deal. And Trump is squeezing China in case if there is no deal to be delivered before the elections. At least he would be the one that who have beaten the enemy and caused the Chinese economy a damage that won't be recovered so easily. By the way, China is a rich country in terms of the state itself, in terms of reserves. but the companies in China are on high leverage, and if there's no trade deal, maybe the Chinese economy would fall in a recession. Technically, gold is trading in a bullish trend above its old daily simple moving averages and above the trend line. 1505 or 1504.72 is the best price to buy gold for a rally that 1500. I believe gold is supported major fundamentals, which I doubt it could change overnight. We have the trade war with China, we have Brexit, we have the global credit and the global industrial recession. After this round, we could expect that gold to land above 1540 and to consolidate for a modest period of time, then to continue to rally to 1820 to 2000 by the start of 2020. That's it for today. Thank you guys for watching this video. Please share, like, and subscribe, and I will see you tomorrow in another video.